Good afternoon, everyone, and welcome to the Global Interdependence Center's executive briefing. I'm Bill Kennedy, your host. Today, the GIC is honored to have joining us Dr. Loretta Mester, the President and CEO of the Federal Reserve Bank of Cleveland. President Mester was appointed to lead the Cleveland Fed in 2014, where she oversees 1,000 employees in offices in Cleveland, Cincinnati, and Pittsburgh. This year, President Mester serves as a voting member of the Federal Open Market Committee, or the FOMC. Dr. Mester started her career as an economist at the Federal Reserve Bank of Philadelphia, where she rose through the ranks and was promoted to Director of Research in 2000 and Executive Vice President in 2010. She oversaw the Philly Fed's economist and analyst, served as the Chief Policy Advisor, and regularly attended meetings of the FOMC. President Mester serves as a director and trustee on numerous boards, including the Greater Cleveland Partnership, the Cleveland Clinic, and the Musical Arts Association for the Cleveland Orchestra. Also, she's an adjunct professor of finance at the Wharton School at the University of Pennsylvania. Dr. Mester graduated summa cum laude from Barnard College with a Bachelor's of Arts degree in mathematics and economics, and earned master and doctorate degrees in economics from Princeton University, where she was a National Science Foundation Fellow. Dr. Mester's research expertise focuses on financial institutions in terms of both structure and efficiency, financial intermediation and regulation, and agency problems in credit markets. Given her background, I can't think of a better qualified person to speak about the monetary policy response to the pandemic. President Mester, welcome to the executive briefing.
Thanks very much, Bill. It's really a pleasure to be here, and I'm proud to say I have a long association with the GIC, and I really enjoy participating and looking forward to today's conversation.
Great, and a conversation it will be. We've decided to go right into sort of the Q&A portion. We've received a host of questions from the GIC membership. We'll try to address those questions, but for our attendees, if you'd like to ask a question, feel free to do so on the dashboard in the GoToWebinar page. Go to the tab titled Questions, type in your questions, and that will put it into the queue. So looking at the questions, I think they're falling into 5 broad categories. The first would be the Fed's toolbox, current and prospective. Second, financial markets, a theme for labor markets. And then, of course, talking about inflation and growth. So in the next hour, let's try to see if we can't cover all 5 of those themes and get the questions answered. But I'd like to kick off with the economic growth theme. So after last week's FOMC meeting, Chairman Powell gave a fairly downbeat assessment regarding the sharp decline in economic activity and the labor market. So maybe you could share with us your assessment of the current state of the economy.
Well, so I'd like to start a little before the current state and sort of just set the tone, right? So, in February, the economy was doing really well. We had, very strong labor markets. Growth was a little bit above trend, and we had inflation nearly up to 2%. We'd made progress on the inflation goal. We weren't quite there yet. And then the pandemic hit. And of course, the country took very aggressive action, right, in order to try to stem the virus's spread, right? And we basically shut down the economy. So that's when we all went inside and we began sort of disengaging from economic activity. And you sort of see that clearly in the data, right? So the first quarter GDP growth came in at -5. My feeling is that the real trough is going to be in the second quarter, and we could see, historically bad numbers on GDP growth in the second quarter. Now the economy is moving into another phase, right? So we had the pandemic shutdown phase. Now we're moving into the reopening phase, and parts of the country in various parts are in different stages of reopening, and you can see that now in some of the data as well. You have the retail sales report, which was quite strong. And you have the employment report in May, which surprised everyone on the upside. And so those are, good reports and to be expected given that the economy is now starting to re-engage in activity. But after that, you're going to be in this longer period, I believe, of recovery. And I think, the numbers on the growth rate numbers in that reopening are going to look big. They're going to look like, wow, we're rebounding. And that's true. But I think it's more reflective to think about in terms of levels, right? So the economy, the May report on the employment report was good. We saw unemployment go down, but it's still over 13%, right? So if you think about the number of people who are unemployed, right, it's currently 1 out of 12 people over 16 years and older. And that's well above what it was even in the worst part of the Great Recession. So again, thinking about levels, I think is the right way to think about it. And it's just going to take a long time, I think, to get back to where we were in February. And that's the way I'm thinking about things, is that we're going to need to have a lot of support for the economy as it goes through this recovery phase. It will recover. It's just going to take some time to recover.
So let's talk about those levels for just a bit. When you think about finishing the fourth quarter of last year, the U.S. economy was $22 trillion in size. How long do you think it'll be before we see the level of the economy get back to that 2019 watermark?
Right. So my forecast, and of course, as you know, the Fed submits forecasts quarterly. We skipped at the beginning of the pandemic because it was just so uncertain, and we submitted them last week at our meeting. My forecast is very much in line with the median path in those forecasts. I think that even at the end of this year, right, we're going to still be GDP will be 6% below the level it was in 2019, and it's going to take the next couple of years to get back up, right, to the levels we saw. So we're going to see the economy recovering, but to get back to pre-pandemic levels, it's going to take another year or two to get to those levels. And similarly, I think that the unemployment rate is going to decline, but I still think at the end of this year, it'll be around 9%, and then it'll slowly decline from there as more people go back to work and the economy can pick back up. So again, I think this is a very, very deep negative shock to the economy, and it's just going to take more time to get back to where we were pre-pandemic. And I think if you talk to our businesses, so in the 4th district, which includes Ohio and parts of Pennsylvania, West Virginia, and Kentucky, when we talked to business contacts, and we of course beefed all that up during this because things were changing so rapidly, we really wanted on the ground information. Everyone started out at the beginning of this thing thinking that, okay, we'll be home for like 2 or 3 weeks and then everything will pick back up. And of course, as everyone, me, myself included, right, this has gone on, was much deeper than people might have expected in the beginning, right? They've adjusted their expectations now. And so, at the beginning, they thought they could get out of this quite, quickly. Now they're seeing that, they are seeing improvement, no doubt about it, but they also realize it's just going to take quite a long time, at least a year, to get back to where they were before.
So that's confirmation of your view that probably a couple of years away before we get back to the 2019 level for the economy.
Yeah, I think, it's hard to obviously forecast that far in the future because a lot of what's going on now depends not only on economics, but also the interaction of economics with the course of the disease, right? So you have to sort of make some assumptions when you're writing down a forecast about how do you think the disease will play out? What do you think about in terms of therapeutics and testing and contact tracing and all that? And then you can make your forecast. So I like to look at scenarios. So, I write down a scenario and say, okay, the economy's reopening. We know from what the scientists tell us and the doctors tell us that we should expect these periodic increases in cases and then maybe falling back in increases. And the real question is, can the healthcare system handle that? Will it get stressed? And so in my forecast, I'm thinking that, yeah, we will be able to handle it. But a lot of what happens, of course, is not only on states saying you can engage in activity. It's about, do people and businesses feel confident that they can re-engage in economic activity, right, and feel safe and assured. So a lot of this is behavioral on the top of medical in terms of the virus, on top of economics. And so this interplay of these three things together, I think, makes it a very hard environment to do economic forecasts. You know this, right? It's very hard to do economic forecasts even in the best of times. Now the interplay of these kinds of things in an unprecedented situation makes it even harder. But I do believe that, the economy is going to recover through this. It's just going to take a long time because it's a very deep shock. And I think if you think about the policy responses that have come both from the fiscal authorities, Congress and the administration, and the Fed, I think that's a case where we took very aggressive actions and more quickly than I think people have done in the past. And I think that's also going to be an important ingredient on how things play out. It's the policy to support the recovery is going to be an important ingredient in that recovery and the shape of the recovery as well.
So let's turn to the policy response. Before I do, there's one question here asking about pulling the lens back a little bit further, looking beyond the 2 to 3 year cycle and thinking more about trend, both trend growth and trend unemployment. Can you just speak to what your expectation for trend growth and unemployment would be on a longer term basis?
Yeah, so far I have not really changed what my longer run view of the economy is. I think trend growth is probably around 2% pre-pandemic. I know there's a lot of thought going into now whether this is going to cause a lot of restructuring, which could mean that growth rates could be lower, potential growth rates lower in the future. But I mean, that restructuring could be also a positive, right? So the ability to work from home and be more electronically knowledgeable than we were before. So I think that's hard to really pin down and saying whether it'll be pro-growth or anti-growth, but I do think that, we knew going before this that growth rates, at least potential growth rates, were going to be lower in the future than they were, right, in previous decades. And I think that's still my outlook, is that we're going to be in a relatively low growth, 2%, or maybe a little bit below, according to some estimates. And that we just really need to think about what the implications of that are for interest rates going forward. I mean, most people think that the natural rate of interest is going to be lower than it was in the past, and that has implications for monetary policy as well.
So to that point, based on your work and the work of the staff at the Cleveland Fed, President Mester, I have to ask, are you even thinking about higher interest rates?
I'm like the median path in that SEP. I believe, and if you think about it, almost every participant on the FOMC has us keeping interest rates at current levels, which are near zero, through the forecast horizon, right? So over the next 2 years to the end of 2022, which is when our forecast ends. And I'm there because I just think that this was such a deep shock to the economy that it's going to need support and very accommodating monetary policy to get us back to that economy that we'd like to be back at, with full employment and price stability with inflation at 2%. It's just going to take, right, that kind of support. And I'm kind of, that's where I am. I think that's the path. Now, of course, we respond, right, depending on how things play out. And as I said, there's a lot of uncertainty around the outlook. But I just believe that to support this recovery, we're going to need very accommodating monetary policy for quite a while.
So to that point, Chairman Powell has emphasized repeatedly that the Fed will use its powers, I think he used the term aggressively and proactively. And there's a long list of extraordinary emergency measures that you and the other FOMC members have implemented. We have interest rates at the zero bound, forward guidance, international swap lines have been opened, and a host of lending facilities that support just about every segment of the economy, whether it's consumer, financial, state, municipal. The Fed clearly has the pedal to the metal, if you will. And the question is, under what principles does the FOMC determine and measure when is enough enough? In other words, when will it be time for the Fed to take its foot off the gas?
Right. So that's a good question. So let me step back a little bit and just sort of give you a kind of the landscape, at least the way I think about the actions we've taken. So early on, right, when the pandemic first began, right, it was very, very critical that the Fed step in and do what it can to make sure that the financial markets continue to function. There was a lot of stress on the financial markets. And so one of our responsibilities is to try to make sure that there's enough liquidity in the market so that trading can happen, right? We don't set necessarily the prices of every asset, of course, but we just want to make sure that there's enough liquidity in the market so that trades can happen. And so that's when you saw the Fed going in and purchasing treasury securities and purchasing mortgage-backed securities, because those markets were incredibly stressed. And you need to have well-functioning financial markets if you want credit to flow to households and businesses. So it was very crucial that the Fed take those actions. And some of the emergency lending facilities were set up precisely to address those stresses in the market. So you think of the money market mutual fund, we have a facility for that, right? We set up facilities for the commercial paper market. So there's a set of those emergency lending facilities which can only be done under emergency conditions with the approval and backing of the US Treasury. Some of those were set up for those purposes. Then another set of actions, and this includes other emergency facilities, were really focused more on making sure that credit would flow to businesses of all sizes, right, and to households. So some of them, like PPP, right, was the payroll protection and liquidity program, was to help, right, encourage and make it banks capable of offering those loans, right, to small businesses. The municipal liquidity facility, again, was set up to help the cash flow problems in certain municipalities and states. So those programs were really trying to get more directly down so that credit could flow to households and businesses. And then we also have encouraged banks by making sure that they know that the discount window at the Fed is open to offer them liquidity if they need it. And we've also relaxed temporarily some of the restrictions on oversight and regulations so that the banks themselves, because they play such an important role in the financial system in the US, are able to lend. So I think of that portfolio as sort of addressing different concerns. And for the Main Street lending program, we announced this week that we're actually looking at the possibility of setting up a second stream of that for nonprofits. So again, we're always looking to see whether there are gaps in the ability of credit to get to various parts of the economy. Now, the question was, when do you step back? Well, legally, we offer these things in emergency conditions, right? So extraordinary exigent conditions, right? So when the economy returns to a more normal financial market so that things are flowing, that would be when you'd think about that. And they all have expiration dates in them, but as Chair Powell said, we would extend those if needed. So again, we're trying to do all we can with the tools that we have, right, to support the economy. And as you also know, we're not authorized to give direct grants, right? We're a lending agency facility, but the federal government has also taken actions to give grants to those people affected by the pandemic and to other parts of the economy that and businesses that were most affected. So that both parties, the fiscal authorities and the monetary authorities, are working to try to use their tools the best they can and as effectively as they can to kind of get through this really deep disruptive shock to the economy.
So supporting the credit market function, improving financial conditions, if we just take a quick look at a scorecard, stocks are up about 40% since March 23rd. Credit spreads, TED spreads, commercial paper spreads, money market spreads all have tightened materially.
Right.
Money supply as measured by M2 is growing 23% year over year. Commercial and industrial lending at commercial banks is up about 30%. A lot of that, I think, because of PPP. And financial conditions have improved. So I guess the question is, mission accomplished, or is there more to do?
Well, I never like to say mission accomplished, because as soon as you say that, then something happens, right? So I think the way to think about this is, it's great that we stepped in to do these facilities. I think, as you've said, right, we have seen improvement, right, in financial conditions and in liquidity conditions in these markets, and that was what these facilities were intended to do. I think that, as we go forward, right, in addition to making sure that the financial markets are functioning well, right, policy is going to have to expand to then really supporting the recovery. And so we're kind of in this transition as things open up. First steps were making sure that the financial markets are functioning so that credit can flow. We're going to continue to make sure that's true. And you're right, we have seen an improvement. And in some of those facilities, right, the amount of purchases have gone down. So for example, we've ratcheted down some of those. We announced at our meeting last week that we're going to continue at the current levels in coming months. But again, we continue to monitor that. And we have seen some improvement in certain markets. There's stresses in other. We're not back to the pre-pandemic levels, but you certainly have seen significant improvement. So that's all good. And now, sort of as the economy reopens and we move into this recovery phase of the economy, monetary policy is going to move into expanding into thinking about, okay, what do we do to support the recovery, guided by our dual mandate goals of getting back to price stability, inflation at 2%, and maximum employment. And we're not there yet, obviously. We're just at the beginning of the reopening phase, and now, right, we're going to see that recovery phase coming, and then we're going to be doing what we can with all our tools to support that as well.
So let me ask one last philosophical question about the Fed's policy in the toolbox. Growing at the Fed, aggressive policies place a heavy thumb on the scales of capitalism, if you will, leading to the mispricing of money, misallocation of capital, concerns about sustaining zombie corporations, and accentuating wealth inequality. How do you respond to those concerns?
So I think those are good concerns to have. You always have to ask yourself whether an intervention is the proper intervention. So I think it's good to have those kind of questions. I think we have a responsibility at the Fed to fulfill our mission, right? And our missions are to make sure that financial markets are smoothly functioning. And so when we saw those stresses build up, it was our responsibility to intervene, right? And appropriately, I would say. But you're right, whenever you use a tool, and I've said this before, whenever you go in and use a tool, you always have to think about not only how to implement it, but also, when to take it back, how to take it back. And so we're not there yet. We're not nearly there yet, given, right, what our forecast and outlook is, right? But, there will be a time when we will have to probably take back some of the things we did. We showed that we did that in the Great Recession, right? So we intervened. We did buy long-term assets. We allowed those assets to sort of stabilize on our balance sheet. And of course, as the economy grew, our balance sheet became a smaller percentage of the economy. And that's how we kind of unwound that. So I think we've shown that we can do that, but it's a good thing to think about, how do you do it, when to do it. And that's certainly something on our radar screen whenever we take action. But in this situation, an unprecedented situation, I fully supported taking the unprecedented actions we took to make sure that we weren't going to get into a financial crisis on top of a pandemic crisis. And I think that was, sort of the goal of that initial stage here, was to really make sure that credit, which is so needed in the economy, could flow down to households and businesses.
Thank you. So this next question has to do with, it's actually two questions. I'll try to combine them. It's relating to the corporate credit facility that the Fed's implemented, both primary and secondary facilities. And the Fed, as we understand, is transitioning from purchasing credit ETFs to now purchasing individual corporate bonds. And there's a host of questions here around this particular facility. And maybe we can just start with why. Why is the Fed implementing this particular facility? And then could you just talk a little bit about the mechanics of the credit facility?
Right. So, I mean, the purpose is, again, in the broad scheme of things is we want to make sure that credit is flowing to all parts of the economy, right? And so that we have facilities that are focused more on small businesses, some on medium-sized businesses, and on large businesses. So think about this as sort of the focus of the larger business part of the financial markets, and that's what the purpose of the facility is. I mean, the mechanics are ones that, you know, we'll look at a dashboard and try to mimic certain indices so that we can sort of make sure that we're not picking winners and losers, but they have to have criteria in terms of being investment grade or were investment grade all but for the pandemic. So again, you know, it's important to realize that the Fed isn't in the business of picking winners and losers. We're trying to do broad purchases so that we are supporting, right, but not necessarily lending directly to particular segments. And we're going to be trying to look at index, you know, mimicking indexes so that we're not sort of putting our fingers on the scales. We also have to make sure that we are, you know, doing our part as, you know, looking out for taxpayers' money. These facilities are backed by Treasury, right? So the investment is the Treasury's, U.S. Treasury puts in money, right, the capital, and then we're lending out. So again, this is about lending facility, right? But we want to do it in a way that is appropriate, effective, but also respects the fact that it's taxpayer money at risk here.
So to that point, what happens if a bond is profitable? What happens to that profit? And on the flip side, what happens if there's a loss or a bond goes into default?
Well, these are on our balance sheet at, you know, the moment. The Treasury has the backing, right? So it's their capital, right? So there is capital backing this facility, right? And that's where the losses would come out. But eventually, you know, they'll be on our balance sheet until, right, the facility is either wound down or those assets can be sold.
Great, thank you. Okay, why don't we turn to a whole host of questions regarding inflation. And this first one I'll preface by saying it appears that we're finally breaking out of a long cycle of, you know, 10 to 15 year cycle of fiscal austerity. Certainly globally. And for over a decade, monetary policy's really been the only game in town. But we're now seeing a pickup in fiscal stimulus in response to the pandemic and the economic shutdown. So how does the Fed, or how do you think about modulating monetary stimulus against a backdrop of stronger fiscal stimulus, which really we haven't had in the era of QE, right? It's all been monetary policy, but now you have fiscal policy coming along. How do you think about that?
Well, both policies, right, are always trying to be calibrated to the economy that we're facing, right? So this was a case where, right, it was very clear that the Fed needed to take action and the fiscal authorities needed to take action. And my personal view is that we're going to need more fiscal support for municipalities and states, given the amount of burden that they've taken on, right, to support the economy and people through this, and more direct support for people who have been so directly impacted by, right, the pandemic. So, you know, we have seen both very sizable packages from both the Fed and, I would say, the fiscal authorities. But I think that even more is going to be needed just because this is such a deep shock to the economy. And even though we'll see in this reopening phase, people coming back to work, right? Not everyone is going to be called back to work. And there is going to remain, I think, quite a few people as the economy recovers that are going to find themselves unemployed. And so we need to do as much as we can to support that recovery and getting those people back to work. And the reasons it's important is, and the economists out there who are listening to this know this, is that, you know, all the research suggests that if those temporary job losses become more persistent, it really brings down, right, the broader economy. It really makes it much harder to get back to where we were pre-pandemic. So I think that it was appropriate for both the Treasury and Congress and the Fed to take these aggressive actions, right? Because it really is this trying to span this, like build a bridge of relief through the pandemic shutdown, and now do what we can to support the recovery going forward. So I know your question was about, do I worry about the fact that we're getting, very large fiscal deficits? And I think that is going to be something that the economy and the country is going to have to deal with once we get back to a growing economy and a recovered economy. We got to make sure our fiscal path is sustainable. But this isn't the right time to do that. We can't be doing that, worrying about that now, because everything we know is if you take decisive action earlier, right, you actually end up with a better outcome later on when a faster recovery, and then we can deal with that.
And so I think the point also was this notion of double barrel stimulus from both fiscal and monetary. Is it possible we could actually, after a long period of below average inflation expectations, could we start to see above average inflation expectations?
Well, I mean, it's interesting, right? When this started, right, people were really concerned that the supply restraints that we saw, like the destruction of the supply chain, would lead to higher inflation, right, rather than lower, right? But right, it's always supply versus demand, right? Demand shock was hugely negative, and so when you see that already in the numbers, right? Inflation is down. My suspicion is going to move down further by the end of the year. And then, right, that's why the support from the Fed is necessary. We're going to be above, our maximum employment. We're going to not have that. We're going to have unemployment high, and we're going to have inflation low. And so it's right for the Fed to be adding accommodation to get back to those goals. It's possible, but this just doesn't seem that way to me. This seems like an event where demand pulls back, right? We have businesses and households probably not re-engaging immediately in activity. And those demand factors are going to be, I think, much more indicative of where inflation is going to be than any kind of temporary supply disruption. So I think it's possible that inflation can move up. But when we see that, that's when you react, right? So again, you always want to calibrate your policy to the economy on the ground and where you think the economy is going. And just right now, it doesn't feel like that's a major concern. In fact, if you were going to be concerned, you'd be concerned about low inflation now, not high inflation.
And the work from the Cleveland Fed, which runs the Center for Inflation Research, where the staff does some really terrific work on the subject of inflation. You have a measure of expected CPI, right, which fell from 1.7% in December to 1.2% recently.
Right.
When do you think that, when would you expect to see that going back towards the 1.7% number? And are there other inflation indicators we should be watching?
Well, that's the center is a really good place to go to if you're interested in inflation. So I'm going to make sure that your listeners here understand that we're really focused broader on just not what the Cleveland Fed produces, and we do produce a number of measures, as you pointed out, but also inflation research and analysis from really globally. And so there's a number of measures we look at. And I think it's always good, and I always do this and tell people this, is that I don't think there's one measure that tells you everything. It's very important that you look across measures, right? Because then you get a picture. It's the same thing with forecasts, right? I'm a big believer in forecast averaging, right? I think it's good to sort of get different viewpoints about how the economy may play out. So I think it's going to take a while for inflation to move back up to our goal of 2%, which is another reason I think that accommodative monetary policy is going to be needed for quite a long time. It is very important that inflation expectations move back towards 2%, because as you know, I'm sure, is that that's a really important component of actual inflation moving back to 2%. So we certainly keep an eye on that. We certainly keep an eye on the various measures of underlying inflation. So the median PCE is important to look at, not only measures that take out food and energy, but also take out the movements that are large relative to the usual monthly moves. So I think to get a true picture of inflation, you have to look at various measures. And what we've seen over the past couple of reports is that all these measures have moved down, not up. And so that's something certainly that the Fed is focused on.
And some of the market indicators, if you look at the embedded risk premium within the nominal treasury yields, or you look at TIPS yields, they would support what you just said, right? They're not moving up. Is that just purely the demand shock has been so harsh, or is there something else at play?
No, I mean, I think just in the last, since the pandemic hit, it's just a hugely, deep pandemic shock. I think in the financial markets, whenever you look at inflation compensation, you always have to be a little bit cognizant of the fact that those movements can reflect things other than inflation, right? So you back out if you do a TIPS, adjustment and TIPS versus nominal, then you get, a measure that could be viewed as an inflation expectation measure. But of course, as you say, risk premiums can move around. So again, looking at both the market-based measures, right, of inflation expectations, looking at the survey-based measures, looking at not only household consumer expectations, but also businesses. And that's one of the things that the Cleveland Fed's working on now is how do you measure expectations of businesses, their expectations, which seems like a natural thing to do since they're the ones who are actually setting prices. Looking at all that really gives you a flavor for inflation. And then, of course, as the Fed, we have to actually project inflation because we're setting monetary policy, which won't affect inflation for quite a while. So again, you do have to be careful of what you infer from the financial market measures, just as you have to be careful of what you infer from a survey measure. And looking at them together, I think is the right way to do that.
So many of us studied the theoretical formula of M times V equals P times Q, and this whole notion that you've had material increase in the money supply, but the velocity of money is suppressed and has been falling persistently. Two questions: does that formula have any relevance anymore? And what is suppressing the velocity of money? What are the factors that are holding that down?
Yeah, so there's a number of factors. I mean, if you think back to the Great Recession, right, we did add, as you say, if you were doing money measures, right, but it's not money that was flowing in the economy, right? That money, banks wanted to hold higher levels of reserves. So there's a demand component of that. Part of it was regulatory, but part of it was also because, right, everyone was more cautious, right? So there was a lot of uncertainty. So at the very start of doing some of the actions that the Fed did, there was a pretty robust discussion about, well, if you increase that and start buying assets and increasing the amount of reserves, are you going to be, right, sort of making an inflationary environment? And what it turned out to be is like, it's only inflationary if it starts flowing out, right, and being lent and part of the economy. And that just wasn't happening given the conditions. And the same thing now, right, is that you could say like, oh, there's a lot of liquidity in the system, but is it being brought to bear in the economy in terms of supporting activity? And so that's when you're thinking about these things, yes, you're right, that is still a truism, but if it's inflationary or not really depends on whether that money is being out, right, and chasing goods and services and then bringing up the price level. And that just isn't happening. It's sitting in banks and sitting in accounts as people have ratcheted up their sort of savings so that they can weather through this.
Great, thank you. Let's turn for a moment to talk about the labor market. During the last crisis in 08-09, we actually saw employers take advantage of the economic dislocation to change some of their labor force practices. Based on your conversations with business leaders and CEOs in the 4th District, are you anticipating labor market reconfigurations from this crisis?
Well, I guess it depends on what you mean by labor market reconfigurations. That's kind of a broad term. I mean, the first thing to note is that early on in the pandemic, our businesses told us, well, we're not intending to lay people off. We were going to keep them on. And as it went on, they faced the reality that they had to do some layoffs, but they said, but we're going to bring them back on staff quickly. Now, right, they're saying, well, we're not bringing them back on quickly as we thought we would at the beginning. So there's that going on. But then there's also the realization that, the way we work is different than it might have been, right, because of the pandemic. And so I think a lot of businesses are rethinking, right, how are they using their labor force? If there's more offsite work, right, how many, maybe they need different kinds of labor than they used before and different types of skill sets than they used before. So I do believe that there's a lot of rethinking sort of staffing levels, but also staffing skills, right? And we're going to see that play out, right, as the recovery goes on. So that's a kind of a reevaluation of the labor force. And I think there's also this realization about sort of benefits and, the people who, unfortunately, the people who are being most burdened by this are the most vulnerable in the economy. If you think about so there's like leisure and hospitality and retail trade. If you just look at those two segments, right, the net job loss since February, those two segments, industrial segments, right, are 50% of the job losses. Those two segments are also the lowest wage in terms of average hourly earnings. And so those kind of disparities, I think, are being illuminated and exacerbated by the pandemic. And so I do expect, right, that realization, right, to affect things going forward. I think there's going to be a reevaluation of some of that, because I think there's now more value on, right, certain parts of the economy than there might have been before. So I think there's a lot of things that could change here going forward, and we'll just have to see how that plays out. But I do think that there could be longer lasting changes, both in terms of making sure that we adjust things so we can remain as productive as we were but also, maybe advantages. Maybe we'll become more productive in certain cases as well.
Any anecdotal evidence in the district that businesses or people are leaving urban areas because they can?
Yeah, I mean, you hear that quite a bit from firms, and for a number of reasons, right? There's the idea that if you can work from home, why would you drive into the city? And the fact that cities usually have a higher tax base or higher tax rates than suburban. So there's going to be that. But then there's also the amenities of cities that people say they still want. So I think we're hearing concern about it. I don't think we're seeing it play out yet, but I do think there's a lot of concern on the part of businesses and reevaluation for the future about how to think about that. I think right now people are just focused on, all right, what do I need to do to stay viable, right, in this environment where I'm facing, less demand for my goods or different kind of operating principles that I have to work under. So, if we talk to restaurants, they're going to have to think about how are they going to stay viable in an environment where they have to practice social distancing. So their capacity is going to be much reduced. So far, some of our restaurants say they're back up to 75% capacity, and that's what they need to be viable. But those are restaurants that have a lot of takeout business. The other ones, not so much. So again, I think that's the main focus now is let's get through this, let's get to the recovery, and then there are going to be these longer run issues that are going to have to be thought about in terms of how do you organize your work.
Great. So we have two questions regarding the banking system. Prior to the pandemic, bank regulators were very focused on commercial real estate exposure levels at the commercial and community banks across the country. Do you see commercial real estate as a potential risk to the banking system or any other risk to the banking system coming from the pandemic?
So going into the pandemic, the good thing was that the banking system was in a very healthy state, right? So the capital levels were up. You know, they were doing, they're better at risk managing, I think, that, you know, those kind of requirements. There were liquidity requirements. So the state of the banking system was in a good shape coming into this. Of course, you know, they're continuing to practice those kind of safety, making sure they're doing safe and sound lending, even with some of the reductions in some of those easing off of some of the supervision to encourage them to lend. So I think the banking system is in a good spot, but nonetheless, this is a deep economic shock. And so they're going to have to continue to look at their portfolios to make sure that they're able to handle the losses, but they're well capitalized, and so they can so far handle the losses. And of course, you know, part of the stress testing that the banks do themselves, right, is a tool that they can use to sort of make sure that they have adequate capital and liquidity. Commercial real estate's interesting, right, because there are different kinds of commercial real estate, of course. But that's an area where the longer run implications of this could affect them, right? We've already seen that. Our contacts, you know, tell us about how stressed, you know, malls, right, in particular, right, the retail segments have been stressed by this, the shutdown, the rent deferrals. And some malls were already feeling the brunt of the trend towards more online sales, right? They had reconfigured themselves in a lot of cases to do more entertainment. And of course, the pandemic then affects that because a lot of those things had to shut down. So this is a longer run issue. And again, that's one of the reasons why the recovery is going to take a long time, because certain segments are going to be affected deeper sooner than other segments. And so this is, again, you know, we're going to continue to monitor that segment and making sure that the banks, right, are operating a safe and sound method, and also making sure that they keep focused on the risks that they're taking on as well.
So staying with the bank theme, and this is in the context of never let a good crisis go to waste. What's the chance we'll see rationalization of the U.S. banking regulatory landscape? Today, we've got overlap between the Fed and the OCC, the FDIC. Is there any discussion or potential to see simplification or consolidation of regulation?
So I would say there's, you know, at the Fed, there's a focus on trying to make our set of the regulations most effective, right? And in some cases, that does mean simplification. Randy Quarles, who's the vice chair for supervision within the Federal Reserve System, that's been one of his themes is, you know, we had to do things after Dodd-Frank to beef up the regulatory structure. As the, you know, the economy recovered and we were in the long expansion, that was a good time to reevaluate, okay, what was working, what isn't working. And you've seen that, right, in terms of the Fed's capital regulations, liquidity regulations, trying to make them, I wouldn't necessarily say streamlined, because I do appreciate that it takes the banks quite a while to sort of make sure they're compliant with those. But I do think there's been a rationalization to make sure that all parts of them are working together and to simplify. I don't think there's any, at least on my radar screen, any talk about consolidation of the regulators, but the regulators do try to work together to make sure that they're not imposing undue burdens and duplicative burdens on the banks. But there is a focus, I know Randy would say that, you know, one of his goals is to make sure that we have a safe and sound banking system and the right regulatory system and supervisory system to ensure that it's effective. And some of that might be simplification and make sure that it's as effective as it can be.
Great. Now, our last banking and financial system related question. How do you think about the risk within the shadow banking system and in the derivatives markets in particular?
So I do think that that's one of the challenges, is having insight into, right, the parts of the financial system that aren't regulated. and or regulated by the Fed in the same way as the banking system is. And so I do believe that that is a challenge and something that we need to be attuned to. And we do within the Fed in terms of our, we do have financial stability reports. And if you look at the minutes of the FOMC meetings, you'll see that we discuss financial stability, and the Board of Governors publishes its financial stability report. You'll see that we take a view frame or a framework that not only looks at institutions, but then looks at markets. And that's where, right, you'll see sort of our view into what's going on in non-bank institutions. So we're looking at an asset level, and we're also looking at a market level, and then also institutional level. But I do believe that that is one of the challenges, is that we, in certain parts of the financial system, we have less insight. On the other hand, making sure that the banks are healthy, right, is important, because even though these are off bank, a lot of these things touch banks, right? So yes, the original loan might be off book, in a different kind of institution, but eventually it flows back through the bank system. So I think by focusing on the banks, yes, we'd like to have better insight into other parts of the financial system, but making sure that the banking system remains healthy is a key goal to making sure the whole financial system remains healthy.
Thank you for that. So let's turn quickly to the Fed's roadmap. And the question here is really two questions, maybe take them sequentially. What can we expect Fed policy to involve as we move into the next phase of the recovery? And there's a question whether there will be more forward guidance, more QE, the prospects for yield curve control, which has been discussed but not enacted, potential for negative interest rates. Is there potential for equity purchases the same way there has been for corporate bond purchases? Together and address how you see the path forward.
So, as I said, I do think that monetary policy is going to be needing to be accommodated to support the recovery going forward. And we have said that we will use all our tools, right, to make sure that the economy gets back to our goals of price stability and maximum employment. So we used a number of tools during the Great Recession, and we've said publicly that those are tools that, are part of our toolkit. And one of them is forward guidance, as you mentioned. The other are large-scale asset purchases that you mentioned. So we have a track record with those. Studies suggested they actually did add accommodation once, interest rates had fallen to zero when we did those tools. We did different formats of those tools through the Great Recession. And so, right, there was learning about sort of what's the best way to implement those. And so if we get to the point where we need to add accommodation, right, then those are tools that we have in our toolkit and that we would bring out and use. We didn't, in June last week, our decision was we're in a good place now to kind of watch how the economy reopens, right? And then, when it gets through the reopening phase into this recovery phase, then we're going to have to probably add support to make sure that we have enough accommodation to support the economy's recovery. Yield curve control is interesting. As you know, Governor Brainerd has given a couple of speeches where she's supports using that, and other economists have come out and said that this is good. We know that Japan is using it, and we know also that the Bank of Australia, Royal Bank of Australia, is using it as well on the short end of the yield curve. And so it's something that I think is worth discussing. I would view it as maybe a way of reinforcing forward guidance. So, on the short end, I can imagine that would be the use of it. But I think we need more work to be able to evaluate whether the benefits outweigh the costs. And again, as I said earlier, whenever you're contemplating a tool, I think you have to think about not only how you would implement it, but how you would take it off. And so there's still more work to go on before I'd feel comfortable coming up with, yes, is this a tool that I want to use, or no, it's not a tool that I want to use. In terms of negative interest rates, I and the chair has said this as well, I know other countries have used this. I don't see this as being a tool that we'd want to use in the US. I think our financial system is different enough, and we have enough other tools in the toolkit that I don't foresee negative interest rate as being something that I would want to use.
And how about equity purchases?
Yeah, and equity purchases, we're not authorized to do equity purchases. So that I don't see us doing either.
Great. Okay, I think we have time for one more question. And I think this is a good one to wrap up on. And it's really in the context of zero interest rate policy, the Fed balance sheet expanding by $3 trillion this year in a very short period of time, likely to expand further. In layperson's terms, can you just articulate what all of this aggressive monetary policy actually means for the average American?
Right.
Why is the policy setting favorable? How does it help the workers? How does it help the business community?
Right. So whenever we're doing monetary policy, our real goal is to meet our congressional mandate, which is two-part: price stability, so inflation at 2%, right, and maximum employment. And by keeping monetary policy, what we say accommodative conditions, right, broad financial conditions accommodated, that helps the average American by making it easier for them to get a loan, by making it easier for them to keep their job, right, to find a job. The economy is stronger, right, they can find a well-paying job. So again, right, mortgage rates are lower, right, they can buy a house, they qualify to buy a house. So, right, this is all about, really, when we do these things, we're really focused on Main Street and, right, what's going to make it better for an average American. And when we're in a situation like we're in right now, right, we want accommodative monetary policy so that firms will hire, right, so that people can get access to lower cost credit, right, so that they can borrow to build a house and know that they'll have a job to pay off that mortgage, right? They can borrow to go to college, right, which means they'll have access to higher paying jobs in the future, right, and they'll be able to pay off those loans. So again, this is all about trying to make sure that, right, we have a strong economy, right, and a strong economy that can work for everyone.
Great. Well, unfortunately, we're going to have to leave it there. Dr. Mester, I want to thank you for a fascinating discussion. We've had some candid questions and some candid responses from you. We really want to thank you for spending time with the GIC community. Thanks to all of you for participating. If we didn't get to your question, we'll try to get back to you if we can. But before we close, just a couple of programming notes. On June 24th, we're hosting part 2 of The Cure and the Disease. This is going to be with the chief epidemiologist and the director of infectious disease from New York City's Montefiore Medical Center. And please note, this is going to be on Wednesday next week. Typically our programs are on Thursday, but we're going with the Wednesday program for the Cure and the Disease. That's going to be followed on July 9th by a presentation discussing the pandemic's impact on agronomics and food security. So we hope you'll join us for both of those events next Wednesday and then again on July 9th. Finally, to learn more about the GIC membership or ways that you can support the GIC, please go to our website, which is www.interdependence.org. And as we conclude, I encourage you to take 60 seconds. Please respond to our audience survey. Your feedback is very important to us, and let us know how we can improve the programming. Dr. Mester, thank you for joining us today. Thanks for all of you for your attention, and good afternoon.